Hello, and welcome to another episode of the Real Estate Investing Club, the place investors go to learn tips, tricks, and stories from other investors in the field. If you feel we provide value to you, go ahead and hit that thumbs up, share whatever it may be, and if you'd like for us to cover a specific topic, let us know in the comments or reach out to us through our website. Today we have a very special guest, so buckle up, grab your pen and paper, and enjoy the ride. All right, we are live. Bill, thank you very much for joining us today. How are you doing?
My pleasure, Gabriel. I am awesome.
That's a perfect response. I love it. Why don't you, to get us started, why don't you tell everybody, who you are, where you're from, and how you got into real estate in the first place?
Absolutely. It's a wonderful story. I became self-aware at the age of 2. So my name is Bill Fairman. I am the fund manager for Carolina Capital Management. And so what we do is we have a fund and we make loans. So we do basically short-term bridge loans. A lot of people call them hard money loans. As a matter of fact, our website has hard money in it, which is a good search term. We're always at the top of the Google search. So I like that part of it. But we do short-term bridge loans for investors, builder contractors for existing homes. We haven't been doing a lot of new construction lately. We're trying to see how the pandemic is going to pan out. So what we're trying to focus in on are loans that are going to be short in nature. If you have a large construction component, it takes a lot longer to complete the project, and you never know how the market is going to act in between time. So we're in the Charlotte, North Carolina market. We lend in the Southeast. We try to lend anywhere North and South Carolina is being touched by another state. We never wanted to conquer the world. We just want to be really focused and understand our particular market. I've been in the Charlotte area since 1970, so I do know the market very well. Got started in the mortgage business in 1989, went through the nice 2008 crash. I actually became a tractor trailer driver for a while. So
wow, that's a good story.
Yes, and that was the problem. I was not a real estate investor then. I was a worker bee in the mortgage business. If I would have been a real estate investor, I would have had additional revenue streams that would have carried me through, and I wouldn't have been driving a truck for a couple of years to make my mortgage payments. But we do what we do to make sure that we pay the bills, and it was a learning experience. And what's the old saying that what doesn't kill you makes you stronger?
Exactly. I think that was a song at some point.
What we like to say here in the South is that adversity builds character, and I am ate up with character. So, I started in the mortgage business doing retail mortgage loans for people that are buying homes or refinancing homes. Eventually, I got into the wholesale side of that. So, I literally saw thousands of transactions, every year. And I finished off my corporate run right before the crash. I was with the company doing mostly commercial loans. So I have a pretty wide breadth of lending experience. And, being in the short-term private lending side of things, there's not really a whole lot of difference. It's all like being an insurance adjuster. You're just judging risk.
Gotcha.
Yeah. So I love the business. We people in the private lending side of things, there's a need for it. It makes it a lot quicker for others to be able to identify a deal and then take advantage of it. And if you're in the fix and flip market, or if you're buying and holding and you're buying a distressed property, typically you got to move on it quickly, and the banks just can't keep up with that.
Yep, that makes sense. All right, so you kind of sum up there. So you got started in the 70s. You were in mortgage. You were just
actually, no. In the 70s, I was 12 years old.
Oh, there you go. You were dreaming of becoming a mortgage officer.
Yeah, I started in 89 as a loan officer.
Okay, so you got started 89 as a mortgage officer. you stayed there for quite a while. You sounded like you started in just regular mortgages for single families. Then you went into wholesale and then into commercial. So you've had quite a breadth of experience when it comes to, loans and underwriting loans. And then the 2008 crash happened. You hopped on a tractor trailer. You did that for a little while.
Yep.
And then you switched paths and you started doing private money lending. Does that sum up everything pretty well?
Yes. My sister, I got her started in the mortgage business in 2001. And, obviously that affected her as well, the 2008 crash. But she had been doing some hard money loans on the side during that period of time. She knew people that had IRAs that wanted a higher return. She knew people that needed money to fix up properties. So she would just put the two together and broker the deals, if you know what I'm saying. Mm-hmm. So she would take the loan fees and they would get the interest rate. And, eventually, more and more people were looking to do that. And she said to me one day, "Hey, let's get back into the mortgage business." So it worked out pretty well. We were taking care of a need. Nobody was lending on anything at that point. It's still, to get a bank loan, you still have to give a blood sample and all kinds of stuff.
Pretty much.
Yeah. So it worked out great for everyone. The people that had the IRAs, they were getting a nice return. They were in a good, secure position because they're in first position on a loan that is already at 65% of the value. And at the same time, the investor had access to cash. You can't scale your business if you're relying on all your own money. And we always tell people they need to find private investors first and foremost, because they're going to be the least expensive to get money from. The problem is most of them don't have infinitely deep pockets, so you always need to have a lender in your back pocket to help with that, and that's kind of where we come in.
Awesome. So that's kind of like how you've got up to today. So kind of tell us, bring us to the current day. What are you guys doing? You're doing hard money lending, but just tell us, get into a little bit more specifics. What do you lend on?
Sure.
What area are you doing? What's the bread and butter to your business?
Well, we have focused, and we turned this around probably, I think it was January of 2019. We made a decision to change our focus and focus strictly on affordable housing, single family affordable housing. We did this. We knew the market was at a peak. We knew something was coming. We didn't think that, COVID-19 was it. But we knew the market was at a peak. And when you get a bit of a slowdown in real estate, generally it's your luxury market that slows down first. The downside to being in the luxury market, it always takes a lot longer to market those properties. You have a lot more money invested into each asset. And as a lender, we always have to look at, if I have to take this property back, what's my plan B and my plan C? You can't rent out $1 million house for your expected return if you end up, owning it and you can't sell it right away. So you have to deeply discount them to sell them quickly, and then you end up, losing a little bit of money that way. So if we focused on the affordable housing and we had to take them back for any reason, those are the most desirable, because you have first-time home buyers, you have people that are downsizing, and you have real estate investors that are all going to be interested in that product. And then at the same time, if you still can't get rid of it, you can at least rent it out for what your expected returns are going to be until the market comes around, and then you can sell those things off. So we are about 90% focused on single family affordable housing in the Southeast. And in our area, below 300 is affordable housing.
Oh, wow. Okay.
So our side of the country is still very affordable. Now, it's a little bit more work for us. Our average loan size is like $158,000. But at the same time, as a lender, I would rather make 5 loans of 100,000 than 1 loan of 100. Now, do we make the same amount of money? Yes. And it's a lot less work doing the $500,000 loan. However, if the $500,000 loan goes bad, I'm not getting an income. If I have one of the $100,000 loans go south, I still got the other 4 that are making up for it, right? So you diversify your risk that way. The other 10% of what we're doing is affordable multifamily, where they're value add, and then self-storage. We really like the self-storage space as well. That's pretty recession resistant, self-storage. And again,
uncorrelated asset, correct?
Yeah, absolutely. So we're trying to stay in the areas where recessions, I'm never going to say recession proof, but they're recession resistant. Everyone needs a roof over their head. They don't need a mansion over their head. They just need a roof. So in any economy, you need 2 things: food and shelter. So that's what we're focusing on.
I like it. Okay. So you guys, it sounded like originally you were focused on a little bit higher class assets, but now you've 100% focused. You're on affordable single family housing with a little bit of multifamily value add sprinkled in there.
Absolutely.
Great.
So I was just going to mention that the Charlotte market a few years ago was just blowing up. Everybody wanted to live inside the city. Mm-hmm. So all these homes were just, like I said, blowing up. They were 700,000-800,000 when I could have picked them up, 7 years ago for about 30,000.
Oh, geez. That's insane.
So we're kind of focusing in on the bedroom communities around the major markets, as it were, the major markets here, because it's too expensive in there. So a lot of the folks are moving out to the bedroom communities, and it's working out really well.
That makes sense. So I kind of want to unpack two different things here. First of all, I mean, I'm an investor myself, and so I've dealt with hard money lending before. So I kind of want to get an actual lender's perspective on what makes what they're looking for, what makes a good deal. How do you get, from the investor's perspective, how do you get your rates to be lowered? Is that just a case of shopping around different hard money lenders, or is there something that the investor himself can do to work with the hard money lender to improve the rates? And secondly, what it's like actually running your business. How do you get your leads, et cetera, et cetera. But we'll deal with that later. Let's first start with, you are a hard money lender, a bridge lender. Kind of tell us from the investor's perspective, what's a way that an investor can structure his presentation, his deal, if he's maybe looking for a specific kind of deal that you would improve your rates on, or are rates always the same across the board? Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Well, there's an inherent risk to anything that has a construction component to it, okay? Mm-hmm. Because unlike watching HGTV, stuff goes wrong most of the time.
All the time.
So you have to, bless you.
Sorry.
So we're always looking at risk. There is going to be fees and rates that are going to be, I don't want to say they're set in stone, because we do have a range. Okay. The best way to get the lowest cost lending is to be a loyal borrower to one or two lenders, number one, because if you have a track record, they feel a little better about doing business with you. Make sure that you're buying properties that are not unusual, and you're not trying to make an unusual product when you're finished. Does that make sense?
Yeah, absolutely.
So the bread and butter for a lender, if they're in single family, and this is the chart. All lenders want a single family home in a subdivision with 2.5 kids playing in the yard, and they want it to be within the median price point of the area. That's your least risky property. Yep. That's what they're looking for. If your lender has, their maximum loan to value after the repairs are made is 65%, you're going to get a better risk if you're at 60%, for example. Okay. If you have a decent amount of liquid assets, you're going to be less of a risk as well. If you have proof that you can make the payments, you still have to go back to those old bank adages. You need to have liquid assets because the lender wants to know that if something happens, which it's going to, that you have the capital to overcome those obstacles, right? And the lender understands that you don't have x-ray vision. Inspectors don't have x-ray vision. If you're taking out a wall, you don't know what's back there. There's going to be stuff that happens. You push the limits on what the lender's guidelines are on any product, you're going to be at the highest risk factor, which means your pricing is going to be a little bit higher. So if you come to the table with a little more money into the bank, you have a good credit rating, you have experience. Experience means a lot, especially now in this particular time. Lenders are very skittish. They don't want people jumping in now that hasn't done it before. You're going to find that your national lenders are going to have the best rates. At the same time, it's the difference between dealing with a local or regional bank versus Bank of America or Wells Fargo. They're going to have the best products, but are they always going to have the best service? Because by nature, they're bigger, more things kind of fall through the cracks. Their response time isn't as quickly. I always encourage people to try to deal with, a local or regional hard money lender because they just have feet on the ground. They understand your market better. And that's, you may pay just a little bit more, but in our business, it's interest only. And the way to get a cheaper return or cheaper cost is to get it done quickly.
That's true.
Give you an example. If you have a 12% interest rate and it's interest only, it's based on an annualized return. So it's based on 12 months worth of payments. Well, if you only make 6 payments, you're not paying 12%, you're paying 6%. Because you're only paying for half of the time. If you knock it out in 3 months, you're paying 3%. Hard money lenders do not make money on the interest rates. They make it on the points, and most of them are 3 to 4 points. And that's us too. We're 3 to 4, depending on your experience and the risk level.
Interesting. I did not know that. I thought that the majority of the revenue for any lending firm came from the interest, and I did not know that it was the points that gives.
Well, it is on fully amortized loans. So if you're doing a loan that's 15, 20, 30-year loan, that's where the money is made over time. Mm-mm. But when you're doing these short-term loans, it's really about the points because most folks aren't going to charge you a prepayment penalty on a loan that is going to be a short-term loan.
Right. Yeah.
It doesn't make sense.
Huh. That's interesting. I did not know that. That's really good to know. Okay. So I want to kind of
one last thing too. You need to be in the proper markets. The higher risk is, if you're looking in a lender's mind, it is, again, if I have to take this back, how quickly can I get rid of this asset or problem and get our money reinvested so we can make more money? So the further away from population centers, that's a higher risk because you have fewer people that are interested in buying it. Again, you want that single family home in a subdivision. You don't want, if you have a log home in the middle of a subdivision where it's regular homes, that's not one you want to get unless you don't want it. Never mind.
There is no unless.
You need to have something that's comparable with what's around it.
Okay.
So that'll help your risk factor as well.
So just to kind of summarize, all the different, elements that you said could improve from the investor's perspective, could improve, their loan, the loan that they receive. You said you look for longer experience, long-term relationships, so people you've dealt with before, people who have high liquid assets, and then also the property has to be in a good market. Does that kind of summarize
Right.
the elements there?
And keep in mind, you have good liquid assets. It's not because they're going to make you use that money, but it's there for the plan B. You're using lenders to scale up your business. You always want to leverage someone else's money because you have more options available if you still have cash in the bank. If you use all your own money, you might be saving some, but what happens if another deal comes up and all your money's tied up into another property? You miss out on that opportunity, right?
I've definitely had that happen myself, so I can attest. So I kind of want to switch gears just a little bit. I want to talk a little bit more about your own business and kind of how you run it. So I understand that have you done flips yourself, or you went straight into hard money?
No, I've always been in the mortgage business. My sister is my partner. She worked for a national real estate investor guru education guy, and he also had an acquisition fix and flip department, and she ran that for years. So she has literally touched 500 fix and flips herself. So wow. It's funny, she can just look at pictures and tell you how much it's going to cost to improve this property or not. So it's nice to have a partner that knows all that as well.
Yeah, that's a good skill to have in your corner for sure.
Absolutely.
So kind of going back to your own business, I always like to ask how people, you're not going to be talking about houses, no motivated sellers, but nonetheless, I still want to ask the questions.
Sure.
So with your own business, what is the best way that you generate leads, generate new clients? Do you do it through digital marketing, through letters? Which channel have you found brings you the most results?
Well, we do a combination. Well, first of all, we've been in the market for, 9 years. So that helps. 9 years as a, hard money lender. Been in the market for ever. But we do a lot with the local RIA groups.
Oh, yeah.
My sister Wendy has a subgroup meeting every Friday morning and has had it for 10 years. She has 50, 60 people show up at a restaurant every Friday morning. Well, not recently. She's been doing it virtually recently. Same thing with me. My meeting is once a month, and I have it here at the office. And we're really just trying to educate folks in all things real estate related. And so it's goodwill, and it gets our brand out there. Our main business is called Carolina Hard Money. So if you're doing a Google search for, hard money lenders, North Carolina, or hard money lenders, South Carolina, we're always on the first page because our name is what we do and where we do it. That's exactly what you're looking for. So we get a lot of stuff from Google, and it's not going to be someone that's just searching for hard money because you're being specific when you're putting in, Carolina, either north or south. So we know we're getting the leads that we're getting there are people that are wanting to borrow money in those states. And then we haven't really done a lot with sending out mailers. It's hard to find a database of potential borrowers, but at the same time, now that I'm thinking about it, I'm sure we can have a search done of people that have flipped homes and be able to send out mailers that way. But we also have a fund, so we're also marketing to accredited investors that want to invest in our fund. So we are on that side of the business. We are in several mastermind groups with physicians and orthodontists and veterinary surgeons and those types of folks. We're teaching them about alternative investing. And then at the same time, we have a live broadcast once a week as well that helps with education. So YouTube helps a little bit. Facebook, we don't do Facebook ads, but we have exposure with Facebook Live and live YouTube events. And then we have a podcast on our. You get to it through our website as well. So all that kind of stuff.
Nice.
Kind of adds up.
So you guys do in-person meetups. You have some pretty good SEO. And then you run a podcast and you also go to masterminds and as an ecosystem that kind of brings you all your clients.
Absolutely.
Perfect. I love it.
By the way, let me plug masterminds while we're here. If you have an opportunity, and it doesn't matter, there are masterminds of all different sizes and categories, business masterminds, real estate specific masterminds. You can't do this on your own. You need people there to tell you if it's a good idea or a bad idea. You need people that are honest, and you need people that can bring stuff to the table. If you're in a room full of people and you're the smartest one in there, you're in the wrong room because you need to get as much out of it as well. So I'm wholeheartedly support meetup groups and RIA groups, and you could advance those and progress into some really good mastermind events. We wouldn't be where we were or are now if it wasn't for mastermind groups.
Yeah, and I will second that myself. I'm part of a mastermind in real estate, and it's surprising. It doesn't seem like a lot, once we do it once a month where we meet up, but it's just that those 2 hours once a month, being able to bounce ideas off people who are doing the same thing that you're doing. It's more effective than you'd think. You get a lot.
You have to look at it this way too. Why make a mistake that somebody else has already made? Learn from them.
Yep, exactly.
Don't reinvent the wheel. Take the system that somebody else has already made and make sure that it, fits. I mean, you have to tweak some stuff, but you have stuff to add. They have stuff to add. It makes everybody better. Just elevates everyone.
Absolutely. And the accountability aspect I found helps a lot. If I tell somebody that I'm going to achieve something, and then I don't do it, I feel like a scumbag and so, just being able to tell somebody that, this is the goal that I'm setting out for, this is what I want to hit. That helps a lot as well.
This is why I'm in group fitness classes. I have to show up.
There you go. You want somebody to be able to say, "Hey, I didn't see you yesterday."
That's right.
All right. So shifting gears one more time, I want to hear a little bit more about your stories, your experiences. We all know real estate is a roller coaster. You got your ups, you got your downs, both financially and emotionally. So kind of take us to the trough, to the lowest part.
Sure.
We all have those experiences. Tell us one of yours, and what was the lesson that you kind of pulled from that?
Well, I have several lessons from the same event. So at the end of 2018, we discovered that we had a builder that was way over his skis. And we ended up having to take 26 properties back at one time. And the least expensive one was $500,000.
Oh, geez.
And they were all in different stages of construction at that time. So we thought from a investor's perspective that, okay, well, we can just take these properties, finish them up, and we would make a lot more money than we would just lending on them. Lesson number one, that's not the case. Because what ends up happening is that you can't get contractors to finish someone else's work.
Interesting.
You can sell them to a contractor and they'll finish somebody else's work, but they're not going to do it for you. They're worried about the liability of stuff falling apart, and then you start blaming them, and it could have been whoever left off's fault. So that doesn't happen. Also, you need to hire 3 full-time people just to deal with that many properties going through that as well. And my poor sister was doing it on her own.
Oh, geez.
So the lesson from there is, as a fund manager, you sell off the ones you can as is quickly as possible. If you have to foreclose on any of them, you do it in a receivership. As a lender, you don't own the property. You never want to own the property, because if you own the property and then you become the contractor, essentially, if you're finishing it up, then you have liability issues. State of California, you're on the hook for 10 years as a contractor for workmanship and materials. Now, where we are, we don't have those issues, but you just want to make sure that you don't change your hats. See, as a lender, if you foreclose and stuff, you're not responsible for that house. But as soon as you start swinging a hammer on it, now you've changed your normal lending business, and now you can become liable for somebody slipping and falling and all that kind of stuff. So you don't want to do it that way. And then the other lesson was, stay out of the luxury market and stick with the little houses.
All right. Like it.
And then the biggest lesson I learned is the fund model is the safest model. So we had nearly 25% of our total portfolio wrapped up in this. Oh, wow. And think about it, if you were doing individual loans on those properties as an individual investor, and you're taking a hit on each one of these, or here's the one thing, you're not getting an income from them because they're not making payments. At the same time, you have more expenses because you're trying to finish them up, keep the grass cut, and all that kind of stuff. And then marketing, if they're finished and they're sitting there, I mean, there's a lot of cost. The biggest cost is not having your money invested. It's sitting on the sidelines. It's lazy money, essentially. But with the fund model, I'm still taking, I mean, we've been really prepared for what happened with COVID. You lose anyway, going back to that, you lose 25% of your portfolio. You don't really lose it. It's just not making any money right now. And the fund still beat the S&P 500, the Dow Jones Industrial Average, and the NASDAQ that year, even with that.
Wow. Not bad. I like it.
So listen, we didn't make a lot, but we didn't lose. And that's why I love the fund model. You can take a big major hit and you're still not losing money. If you're doing it individually, you could lose a bunch of money. And this is why I love the fund model so much. So after that, that's why we went to strictly the small single family. We also put in place things that would trigger not having one person that had so much of a higher percentage of the portfolio. We knew this going in. We never let anybody have more than 10%. But unfortunately, he wasn't just a borrower. He was also a contractor on other borrowers' properties. And that's so we learned there. You live and you learn.
Good lesson learned.
But that was the lowest. And I'm telling you, it hurt.
Yeah.
We restructured for our investors. We didn't take a lot of our fees. We passed it on to the investors to make sure that they got close to what their returns were. So I don't want that to happen again either. My wife will kill me if I do that again.
All right.
Okay.
So that's the trough. Now take us to the peak. I mean,
so 2019, we had our biggest year.
Congratulations.
That's interesting. we made the most money, and we did the most loans, and our default rate, and by the way, our default rate since we started has been less than 2%.
That's awesome.
And that one blip, and then since then, again, it's back to less than 2%. But it's been when we switched to that model and we're doing smaller properties at a smaller loan amount, our volume went up dramatically. And that's where everybody wanted to shift anyway. So we were kind of ahead of the curve. And what happened because we were doing that, and because I'm in a mastermind and we were preparing for a downturn in the economy, we already had the checklist of what we needed to do when COVID and the shutdown happened. And so, again, we only had like 4 properties that we had to do any modifications or forbearance on. We only did 4 loans the entire month of April. And it wasn't because we didn't have plenty of people that wanted loans. We were just being really picky about who we made a loan for until we saw how these things were going to pan out. And now we're back to lending full bore again.
That's great. Your best year ever. That's really fantastic. You always like to hear that stuff. So we try to keep these, to around a half hour. So we are, nearing the end of our show here. But we all need things. And so why don't you tell us, if somebody listening were to bring you something, what is it that you would like, to receive, and what is it that you can offer here?
Okay. So if you're an accredited investor, and if your folks don't know what an accredited investor is, it's basically what the government says is accredited. So you have to have $1 million in net worth, not counting your primary residence, or you have to have income for the last 2 years of a single person, $200,000 a year, or a family of $300,000 a year. You can invest in our fund, and our fund has had a really good return. And without a whole bunch of disclaimers, I'm not going to tell you, but it's we like the tortoise and the hare thing. We have really decent returns. They're quarterly. It's great for an IRA as well. If you're not accredited, we still have options for you as a lender as well. You would just be in an individual loan. And then if you're someone that's interested in borrowing money from us and you're in the Southeast, we can do that too. So the easiest thing is to go to carolinahardmoney.com. If you're a potential investor or lender, just click on the investor tab. If you're a potential borrower, just click on the borrower tab. Couldn't be any simpler.
Perfect. And piggybacking off that last comment, if somebody wanted to get in contact with you regarding the fund, regarding, hard money loan, any of those, what would be the best way to reach out?
Sure. Go to the website if you're going to borrow money. If you're trying to invest money, my email address is bill@carolinahardmoney.com. Perfect.
All right. Well, Bill, I'm sure I can speak to everybody listening and watching. I appreciated it, and I'm sure everybody else did. We love the wisdom that you shared. Thank you for coming on. And for everybody listening and watching, if you want to get in contact with Bill, either to invest or to receive a loan, you can email him at the email he just shared, go to his website, or I'll put his LinkedIn in the show notes. So until that, we look forward to seeing you guys on the next episode.
Thanks for having me.
Thank you for joining us on the Real Estate Investing Club. If you feel we provided value, we would appreciate it if you hit that thumbs up, share it with your friends online, whatever it may be. If you'd like to share or partner with us on an investment deal, we are always looking for quality projects. Go to www.therealestateinvestingclub.com to get in contact with one of our partners. Otherwise, I hope you guys have an absolutely fantastic day, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.